A single day in the Strait of Hormuz can move enough oil to shake the global market. But in a crisis, the most valuable cargo is not always the oil. It is the fear around it. When this narrow passage between Iran and Oman looks unsafe, money starts moving before the tankers do. Oil prices react, freight rates shift, war risk insurance rises. Buyers search for safer supply. Ship owners decide whether the premium is worth the danger. Governments with reserves can wait. Countries without options have to pay. That is why Hormuz is not just a waterway, it is a financial trigger. The world may see ships returning and assume the crisis is ending, but by the time the route begins to reopen, fortunes may already have changed hands. Some players sold into panic, some charged for danger, some protected themselves with storage, contracts, and naval power. Others were forced to buy certainty at the worst possible moment. So the real question is not whether the strait is open. The real question is who got paid while the world was afraid it might close. The Strait of Hormuz looks small on a map. That is what makes it dangerous. It is a narrow passage between Iran and Oman, linking the Persian Gulf to the open ocean. But through that passage moves enough energy to alter inflation, shipping costs, government budgets, fertilizer prices, industrial margins, and the bargaining power of countries far from the Middle East. This is not just geography, it is dependency compressed into water. Before the crisis, the strait functioned like a routine artery of the global energy system. Tankers crossed, cargoes were booked, insurers calculated in the background, and buyers treated passage through the Gulf as a normal part of trade. Then, conflict turned routine movement into a question. Could ships still pass safely, predictably, and profitably? That question was enough to move money. The Gulf contains some of the world's most important energy exporters. Saudi Arabia, Iraq, Kuwait, Qatar, the United Arab Emirates, and others all depend in different ways on the ability to move oil, gas, and related products out of the region. Some have pipelines or export options that reduce exposure. Others have far fewer alternatives. But every exporter faces the same basic truth. A barrel that cannot reach a buyer is not the same as a barrel that can. The same is true for importers. Asian buyers are especially exposed because so much Gulf energy moves east. Refineries, utilities, petrochemical plants, airlines, shipping firms, and industrial buyers do not simply need energy in theory. They need specific cargoes at specific times, delivered through specific routes, under contracts that assume the route will function. When Hormuz becomes uncertain, those assumptions begin to crack. A refinery manager may not know whether a cargo will be delayed. A ship owner may not know whether a tanker should enter the Gulf or wait outside. A trader may not know whether the next diplomatic signal will crush the risk premium or send it higher again. An insurer may not know whether yesterday's routine passage has become tomorrow's war risk exposure. That is why Hormuz matters before it closes completely. A total shutdown is not required. The market reacts to probability. If the passage looks unsafe, buyers begin searching for replacement supply. Ships begin repositioning. Freight changes. Insurance changes. Storage becomes more valuable. Governments begin calculating how long reserves can cover demand. The price of oil becomes only the most visible symptom of a much larger financial adjustment. This is the machinery behind the headline. A narrow route becomes a signal. The signal becomes a price. The price becomes a cost. And the cost moves outward through the global economy. The scale is not only measured in barrels. It is measured in how many systems depend on the same corridor. Oil is the obvious part of the story, But Hormuz is also tied to liquefied natural gas, petrochemicals, sulfur, urea, and fertilizer-linked supply chains. When LNG is disrupted, the pressure can move into electricity markets and industrial fuel. When fertilizer inputs are delayed or repriced, the pressure can move into planting decisions, food costs, and public budgets. A shipping lane that begins with oil can end up inside the price of food. That is the first thing many viewers miss. The Strait does not only connect producers to buyers, it connects energy to agriculture, shipping to inflation, insurance to household budgets, and military risk to corporate margins. During the recovery, this complexity became even clearer. Ships started moving back. Analysts lowered oil price forecasts as supply fears eased, but the tanker system itself was not simply back to normal. Ship tracking and freight data showed a fragile middle ground. More vessels moving toward the Gulf, but actual cargo throughput still below pre-conflict levels. The route was reopening, but confidence was lagging behind steel. That gap is the story. A ship crossing the water does not automatically mean the financial system trusts the route again. The cargo still needs insurance. The charter still needs terms. The buyer still needs delivery certainty. The crew still needs a safe corridor. The exporter still needs working ports, reliable access, and customers willing to accept the risk. This is why the phrase, "the Strait reopened," can be misleading. Reopened doesn't always mean normalized. Reopened can mean ships are testing the route. Reopened can mean tankers are moving faster than cargo demand. Reopened can mean some prices fall while other costs remain embedded. Reopened can mean the emergency phase is easing, but the memory of the crisis is still inside contracts. That's where the money begins to move in less obvious ways. The winners are not always the countries closest to the Strait, and the losers are not always the ones shown in the headline. A Gulf exporter may own the oil, but still be vulnerable if its route to market becomes risky. A trading firm may own no coastline, but profit from timing. A shipowner may not care about the politics, but care deeply about whether the next voyage pays enough to justify the danger. A buyer with reserves can wait. A buyer without reserves may pay. This is the central contradiction of Hormuz. It can punish dependence while rewarding flexibility. Before asking who profits, we have to see the Strait for what it really is. Not just water between two coastlines, but a financial valve in the global economy. When that valve tightens, money changes direction. The first thing that moves in a Hormuz crisis is not always the oil. It is the price of fear. Oil markets do not wait for every barrel to disappear. They respond to probability. If traders believe a major route could be disrupted, even temporarily, the price begins to include a risk premium. That premium is not imaginary. It is the market placing a dollar value on uncertainty. During the crisis, oil benchmarks climbed to extreme levels. Later, as shipping flows began to recover, analysts cut their forecasts. Brent was projected lower for 2026, and WTI was also revised down. That shift matters because it shows how quickly the market can remove part of the geopolitical premium once supply fears ease. But it also reveals something deeper. The money was moving long before the final outcome was known. A refinery in Asia still needs crude. An airline still needs jet fuel. A chemical plant still needs feedstock. A power system still needs gas. Demand does not vanish because the passage becomes dangerous, so buyers protect themselves. They look for alternative cargoes. They pay attention to replacement costs. They decide whether to buy earlier, from farther away, or at a higher price. That is where the first transfer of money happens. If a company already holds oil when fear rises, that inventory becomes more valuable. If a trader secured supply before the disruption, the contract can become more powerful. If a buyer waits too long, the same cargo may cost more. Nothing has changed inside the barrel. The route behind the barrel changed the value attached to it. That is why a choke point is different from an ordinary delay. A delayed vessel is a logistics problem. A threatened choke point is a pricing event. Then, freight reacts. A tanker entering a risky corridor is not the same asset as a tanker sailing a calm route. The owner may demand more compensation. The charterer may hesitate. Some vessels wait outside the Gulf. Others rush back before cargo volumes fully recover. Some take longer routes. Others get caught in queues, safety checks, or military coordination. The tanker market does not move as one body. Very large crude carriers on Middle East routes can behave differently from smaller product tankers elsewhere. In the recovery, large tankers moving from the Middle East to China saw rates fall sharply as vessels accumulated ahead of actual cargo demand, while some smaller tanker routes strengthened because ships had been pulled away from other markets. That is the second profit engine, fleet positioning. If this is the kind of financial analysis you want more often, subscribe to Capital and Consequence. The next layer is insurance. A ship does not enter Hormuz only with fuel and a crew. It enters with coverage, liability, risk assessment, route permissions, security decisions, and contract language. When perceived danger rises, the cost of moving through the area can rise, even if the ship is never attacked. War risk insurance exists because a single event can turn a routine cargo into a catastrophic loss. In a normal market, insurance sits quietly in the background. In Hormuz, it can move closer to the center of the story. The danger itself becomes something priced, negotiated, and passed along. Then comes inventory. Countries and companies with reserves have options. They can wait. They can release supply. They can delay purchases until prices calm. Buyers without reserves have fewer choices. They may need to pay the market price because their refineries, power systems, airlines, or factories cannot simply pause. Stored energy becomes bargaining power. This is one reason large economies with strategic reserves can absorb a shock better than smaller importers. A major buyer can use inventory, purchasing power, and long-term relationships to manage volatility. A vulnerable economy may face the same headline price with a weaker currency, higher borrowing costs, fewer suppliers, and less room in the public budget. The same barrel creates different consequences depending on who needs it. Hormuz also reaches beyond crude oil. When LNG trade is disrupted, the pressure can move into electricity and industrial fuel. When fertilizer-linked materials slow down, the effect can move into agriculture. This is how a maritime choke point becomes a food cost problem. The public watches the oil price, but the deeper system is moving through delivery windows, freight bills, demurrage, insurance clauses, storage decisions, hedges, and credit lines. A higher freight cost can become a higher landed price. A higher landed price can become a government subsidy, a consumer bill, or a lost margin for an importer that cannot pass the cost forward. And then comes the political layer. Hormuz is not controlled by a spreadsheet. It sits inside a region shaped by military forces, sanctions, naval escorts, diplomacy, route controls, and national interests. If ships need protection, someone provides it. If mines are suspected, someone must clear them. If one corridor is considered safer than another, insurers, governments, and shipowners react. The route becomes more than geography. It becomes a negotiation. That negotiation has a price. So the mechanism is simple but powerful. Risk enters the market. Price changes. Ships reposition. Insurance adjusts. Buyers search for alternatives. Governments intervene. Then the cost lands somewhere. Company margins, household energy bills, food prices, freight contracts, or public budgets. The Strait of Hormuz becomes a money machine because it converts uncertainty into payments. And the most important payment is often made by the actor with the least flexibility when the crisis begins. The most visible player in a Hormuz crisis is usually the oil producer. But the first major beneficiary is not always the country pumping the crude. Often, it is the actor positioned between fear and delivery. That can be a trading firm holding cargo before the market reprices. It can be a company with storage capacity when buyers suddenly want security. It can be a shipowner with vessels available when other ships are waiting, rerouting, or avoiding the Gulf. It can be an insurer charging for a danger that did not exist at the same level before the crisis. It can even be a government that uses the moment to prove that its protection, diplomacy, or alternative supply matters. This is why profit in Hormuz must be handled carefully. A crisis does not make everyone in the energy system rich. It rearranges advantages. Some actors capture the premium, others absorb it. Start with traders. A trading firm does not need to own the strait. It needs timing, contracts, financing, storage, access to cargo, and information. If it secured supply before fear entered the market, the value of that supply may rise. If it can move cargo when others cannot, it may capture the spread between panic and delivery. If it can buy from one region and sell into another where replacement supply is scarce, geography becomes margin. The public sees a barrel price. Traders see relationships, crude grades, delivery months, port access, freight, insurance, credit, storage, sanctions risk, and destination markets. A Hormuz crisis changes many of those relationships at once. The barrel itself may not change, but the conditions around it change completely. That is the first engine of profit: volatility. Then come the shipowners. A tanker is not just transportation. In a crisis, it becomes mobile optionality. A ship in the right ocean, with the right size, the right approvals, the right crew, and the right tolerance for risk, can become more valuable than a ship positioned somewhere else. But the market is not simple. If too many vessels rush back toward the Gulf before cargo flows recover, rates on some routes can collapse. If vessels leave other markets, rates somewhere else can rise. That is what makes Hormuz financially complex. The winner is not automatically the largest shipping company. The winner may be the one whose fleet is positioned correctly while everyone else is still reacting. A tanker owner can earn from scarcity but lose from congestion. It can charge more for risk but face delays, inspections, route controls, or uncertain cargo availability. In that sense, the strait creates both opportunity and trap. The vessel that looks valuable on paper still needs a buyer willing to pay, a route that can be used, and cargo that can actually move. Insurance works differently. The insurer does not profit from destruction. It prices the possibility of destruction. When perceived risk rises, the premium can rise before damage occurs. War risk coverage, crew safety, liability, cargo exposure, and route assessment all become part of the cost of moving oil through a dangerous corridor. This is one of the least visible forms of profit in a choke point crisis. No one needs to block a ship. No one needs to stand on the coastline. The risk itself becomes a product. Then there are producers outside the most exposed route. If buyers fear disruption in the Gulf, they look for alternatives. That can benefit suppliers whose oil, gas, refined products, or replacement cargoes do not depend on Hormuz in the same way. The advantage may be temporary, but temporary does not mean small. A refinery that wants certainty may pay more for a cargo from a safer route. A country that can deliver without the same choke point exposure gains negotiating power. Reliability becomes valuable because uncertainty has become expensive. But the most powerful winner may be the buyer who prepared before the panic. A country with strategic reserves, diversified suppliers, flexible contracts, and strong credit can wait longer. It does not need to chase every headline. It can release inventory, delay purchases, or negotiate from a stronger position. A country without reserves has less room. It may need to buy at the worst moment, with weaker currency, higher transport costs, and fewer alternatives. That difference turns preparedness into economic power. Large importers with deep storage and diversified supply chains may suffer less than poorer importers, even when they both depend on the same route. The market price may be global, but the impact is not. The strongest buyers can absorb volatility. The weakest buyers experience it as a crisis. Governments also gain in ways that do not appear directly on a balance sheet. A naval power that can escort ships gains relevance. A regional state that can help manage safe passage gains diplomatic leverage. A country that controls territory near the strait gains bargaining power because the world cannot ignore the geography. A government that can keep exports moving while others hesitate can turn reliability into influence. In a Hormuz crisis, profit is not only measured in dollars per barrel. It is measured in bargaining power, market share, contract control, security dependence, and the ability to make others wait. That is the deeper answer to the question opened at the beginning. The money was not made only when ships returned. It was made while everyone was deciding whether those ships could return at all.
Every crisis creates a map of winners. Hormuz creates another map, usually less visible. It is the map of who pays. The cost does not fall neatly on one country, one company, or one group of consumers. It moves through the system in layers. A refinery pays more for replacement crude. A shipping company pays more for risk. A farmer pays more for fertilizer. A government pays more to protect household budgets. A small importer pays more because it cannot wait. A crew takes the physical risk of sailing through a corridor that financial markets describe in numbers, but sailors experience as danger. This is how a maritime choke point becomes a cost transfer machine. The first exposed group is the energy importer with few alternatives. A wealthy importer with reserves can buy time. It can release inventory, negotiate with suppliers, absorb temporary price spikes, and use financial markets to hedge part of the shock. A poorer importer often cannot do the same. It may face higher fuel costs, weaker currency, rising freight charges, and tighter public finances at the same time. The oil price may be global. The ability to survive that price is not. That is why vulnerable economies matter in this story. UN trade officials warned that even after the strait began reopening, food and transport systems could take longer to recover than energy markets. That is the hidden damage of a choke point. The oil benchmark may fall first, but fertilizer, transport, food distribution, and household budgets can remain under pressure after the headline price improves. A country that imports fuel, food, and fertilizer can be hit several times by the same crisis. Diesel affects trucking, trucking affects food distribution, gas affects electricity, fertilizer affects planting. Higher transport costs move into food prices move into political pressure. A narrow passage in the Gulf can end up inside the budget of a family that has never heard of the Strait of Hormuz. The second group that pays is the producer trapped behind a route. This sounds strange because oil producers are often seen as winners when prices rise, but a producer cannot profit from a barrel it cannot export. If a country depends heavily on Gulf shipping and lacks enough alternative capacity, the strait becomes a gate. When the gate is risky, customers hesitate. When the gate is slow, cash flow slows. When the gate is contested, producers may face discounts, delays, or pressure just to move their own product. Ownership of the resource is not the same as control over the route. That distinction is central to Hormuz. The Gulf may hold enormous energy wealth, but that wealth must still pass through ports, ships, insurance, route decisions, security guarantees, and buyers willing to accept delivery risk. A country can have oil in the ground and still be financially exposed if the path to market becomes uncertain. The third group that pays is the industrial buyer downstream. For manufacturers, airlines, petrochemical plants, fertilizer buyers, and utilities, energy is not a headline, it is an input. When the input cost rises, the company has three choices: absorb the hit, pass it to customers, or reduce activity. None is painless. If the company absorbs the cost, margins fall. If it passes the cost forward, consumers pay. If it reduces activity, workers, suppliers, and governments may feel the effect. This is how a tanker crisis can eventually appear in factory output, food costs, transport fares, and public budgets. The fertilizer shows the mechanism clearly. Hormuz is tied not only to crude oil, but to materials that support agriculture and industrial production. When fertilizer-linked flows slow or become more expensive, the effect can move into planting decisions, crop costs, food prices, and subsidies. The consumer may never think about Hormuz while buying groceries, but the strait can still be inside the price. Then there is the human risk. A ship is not an abstract asset. It carries a crew. It enters waters where decisions made by governments, navies, insurers, and charterers can become real danger for people on board. When a vessel is attacked, delayed, evacuated, or forced to wait for safe passage, the cost is not only financial, it is operational, psychological, and human. The documentary lens has to be careful here. The point is not to turn danger into spectacle. The point is to understand that the risk priced into a contract is often carried by someone at sea. The final payer is often the public. Governments may release reserves, subsidize fuel, support food prices, protect critical industries, fund naval operations, or absorb inflation through public spending. This is the uncomfortable truth behind the Strait of Hormuz. The actors with the most flexibility often pay last. The actors with the least flexibility often pay first. Traders can reposition. Large buyers can wait. Some shipowners can choose routes. Governments with power can negotiate. But the small importer, the exposed producer, the farmer, the crew member, the fuel-dependent household, and the vulnerable economy may have fewer choices. That is why asking who profits is only half of the story. The other half is asking who is forced to buy certainty after the price has already gone up. At a certain point, the Strait of Hormuz stops being only an energy story. It becomes a power story. Whoever can influence the passage does not need to own the oil beneath the ground. They only need to affect the cost, timing, or confidence required to move it. That is a different kind of leverage. It is quieter than production. It is harder to measure than reserves, but in a crisis, it can become just as important. A barrel of oil has value because someone can use it. But before it becomes fuel, electricity, petrochemicals, airline capacity, or government revenue, it must reach a buyer. It must pass through a port, onto a ship, through a route, under insurance, within a contract, and into a refinery or terminal. Every step is a possible pressure point. Hormuz is one of the largest pressure points in the world. For Iran, geography is leverage. The strait is not controlled by one country in a simple way, and maritime rights are shaped by law, military presence, and practical security. But Iran's position along the northern side of the passage gives it strategic weight. Even the perception that Iran could interfere with traffic can affect markets, insurers, navies, exporters, and buyers. A threat does not need to become a permanent blockade to become financially meaningful. That is the strange power of a choke point. It can move money through anticipation. For Gulf exporters, Hormuz is both gateway and vulnerability. Their energy wealth gives them global importance, but the route out of the Gulf determines how easily that wealth reaches the market. Some countries have alternative pipelines or export capacity outside the strait. Others are more exposed. That difference changes security priorities, investment decisions, and diplomatic behavior. A country with more exit options has more room to maneuver. A country with fewer options depends more heavily on the stability of the passage. For the United States and other naval powers, Hormuz creates another form of influence. Security becomes a service the global economy depends on. Naval patrols, escort operations, demining capacity, intelligence, surveillance, and military presence all become part of the economic system. They are not only defense activities, they are part of what allows oil, gas, fertilizer-linked materials, and commercial shipping to keep moving. When markets believe security is credible, risk premiums can ease. When security looks uncertain, risk returns quickly. This is how military capability becomes financial credibility. No trader needs to quote a naval deployment on a screen for it to matter. The effect appears in the confidence of shipowners, the willingness of insurers, the behavior of charterers, and the price buyers are willing to pay. The warship may not be listed on the invoice, but the cost of its absence may be hidden inside the invoice. Then there is diplomacy. Hormuz is not only a confrontation zone, it is also a negotiation space. Safe passage, de-escalation, communication, inspection, and regional arrangements often require actors that can speak across divides. A mediator can become economically important not because it sells the oil, but because it helps reduce the uncertainty around moving it. Power is not always the ability to stop something. Sometimes it is the ability to make movement possible again. This is where money and diplomacy merge. If one country can reassure shipowners, it gains influence. If another country can raise doubts, it gains leverage. If a buyer can wait because it has reserves, it gains bargaining power. If an exporter can reroute supply, it gains resilience. If a government can protect vessels, it gains relevance. If an insurer can define the cost of danger, it shapes the price of passage. The strait turns all of these roles into power. That power is not evenly distributed. Large economies can use reserves, credit, and diversified suppliers. Smaller importers often face the crisis as a price they must accept. Major energy companies can move cargoes, hedge exposure, and renegotiate terms. Smaller buyers may not have that flexibility. Naval powers can protect routes. Poorer states cannot send fleets to secure their supply. This imbalance is one of the clearest consequences of Hormuz. A crisis at the strait does not hit every country with the same force. It tests how much strategic depth each actor has. Inventory, suppliers, routes, currency strength, diplomatic access, military protection, and time before the shortage becomes political. Time itself becomes a form of capital. The country that can wait has power. The company that can wait has power. The shipowner that can refuse a dangerous voyage without losing the business has power. The buyer that must purchase today
at any price has much less. This is why the strait matters beyond oil. It exposes dependence. It reveals resilience. It shows which governments can absorb a shock and which ones must move the cost quickly to citizens, companies, or public budgets. Energy security is not just production. It is optionality. And optionality is power.
If you have stayed with us this far, subscribe to Capital and Consequence for more long-form documentaries about money, power, and the consequences behind the headlines. Now, the final question is what happens next? Not what should happen, not what officials hope will happen, but what the available evidence suggests could happen if Hormuz moves from acute crisis into fragile recovery. The first scenario is managed normalization. Under this scenario, ships continue returning, cargo volumes recover gradually, insurers reduce the cost of risk, and oil prices lose more of the geopolitical premium that entered the market during the disruption. This is the scenario markets prefer because it allows the system to rebalance without another violent shock. Tankers move again, buyers rebuild confidence, producers resume deliveries, governments claim stability, traders unwind positions that were built for panic. But managed normalization does not mean the crisis leaves no trace. Contracts may still change, importers may still diversify supply, ship owners may still demand more protection for dangerous passages, governments may still revisit strategic reserves, energy companies may still price future shipments with a memory of what happened. The immediate premium can fall, while the long-term risk assumption remains higher than before. That is the first lesson of Hormuz. Price can calm down before the system fully trusts the route again. The second scenario is the contested corridor. In this version, the strait is open but not normal. Ships move but cautiously. Some cargo flows recover, while others remain delayed. Naval escorts, route planning, insurance decisions, and political negotiations remain close to the center of the market. This is the most complicated scenario because it produces mixed signals. Oil prices may fall, suggesting relief, but physical cargo volumes may remain below normal. Tanker movements may increase, suggesting recovery, but empty vessels may be positioning ahead of demand rather than proving that exports are fully restored. Insurance may ease for some ships while staying elevated for others. A buyer may see a lower benchmark price but still pay more once freight, timing, and risk are included. In other words, the headline price can say calm while the logistics still say caution. That gap is where money continues to move. The third scenario is a renewed shock. This does not require a full closure. A single attack, a mine scare, a failed negotiation, a sanctions escalation, or a military miscalculation could be enough to bring risk back into the market. Markets do not need certainty to react. They need probability. If the probability of disruption rises again, oil, freight, insurance, and alternative supply routes can reprice quickly. Under this scenario, the winners are again the actors with optionality. Buyers with reserves can wait. Traders with flexible contracts can reposition. Producers outside the Gulf can become more valuable. Ship owners with available vessels in safer routes may gain leverage. Governments that can provide security or diplomacy become more important. The exposed importers, least flexible buyers, and countries with weaker finances face the highest pressure. This scenario reminds the world why choke points are never only about today's traffic. They are about tomorrow's confidence. The fourth scenario is overcorrection. In this version, markets prepare for a longer crisis than the one that actually unfolds. Ships move toward the Gulf expecting strong demand. Producers try to clear delayed cargoes. Buyers delay purchases because they expect prices to fall.
inventories rebuild. The result may not be a shortage, but a messy rebalancing in which some freight markets weaken, some cargoes face discounts, and some players who positioned for a prolonged crisis discovered that the premium disappeared faster than expected. This is why a crisis can punish late arrivals on both sides. The buyer who buys too late may pay the panic price. The ship owner who moves too late may arrive after the best rates are gone. The trader who holds too long may watch the premium vanish. The producer that waited for better terms may face a market that suddenly has more supply than urgency. In Hormuz, money is made by timing. It is also lost by timing. For the global economy, the biggest risk may not be one single scenario. It may be that all of them remain plausible enough to affect behavior. If the route normalizes, prices can ease. If it stays contested, costs remain embedded. If a new shock appears, risk returns. If the market overcorrects, some players are left with the wrong ships, the wrong cargoes, or the wrong contracts. This is the uncertainty premium. A closed choke point is an emergency. A half-trusted choke point is more subtle. It becomes a standing reminder that energy security, trade costs, and geopolitical power can still be reshaped by a narrow passage the world cannot ignore.
The Strait of Hormuz becomes a money machine in a crisis because it does something few places on Earth can do. It turns movement into doubt. And once movement becomes doubt, doubt becomes price. That is the answer to the question we opened with. The money is not made only when oil is produced, refined, shipped, or sold. It is made when a buyer fears delay. It is made when a ship owner decides the voyage now requires a higher reward. It is made when an insurer recalculates the cost of danger. It is made when a trader holds the right cargo before the market panics. It is made when a country with reserves can wait, while another country has to buy. This is the hidden power of Hormuz. It sits between supply and need. On one side are the Gulf exporters, terminals, ports, gas facilities, tanker fleets, and governments whose revenues depend on movement. On the other are refineries, utilities, airlines, fertilizer buyers, factories, farmers, and consumers who depend on delivery. Between them is a narrow passage where confidence can disappear faster than cargo. That is why the crisis does not end simply because ships begin moving again. A tanker can cross the water while trust remains damaged. A benchmark oil price can fall while freight, insurance, timing, and risk still reshape the real cost of delivery. A government can say flows are improving while buyers still ask whether the next cargo will arrive safely. A ship can be visible on tracking systems while the financial system behind it is still treating the route as unstable. This is the difference between reopening and normalization. Reopening is physical, normalization is financial, and financial trust takes longer to rebuild. The obvious winners are the players who captured the premium, traders with the right timing, insurers pricing danger, ship owners positioned correctly, alternative suppliers outside the most exposed route, and prepared buyers with storage, credit, and options. But the deeper winners are the actors who gained bargaining power. The country that can wait, the exporter with another route, the naval power that can protect passage, the mediator that can reduce uncertainty, the buyer with reserves, the company with flexible contracts. In a crisis, flexibility becomes capital. The losers are not always the ones named in the headline. They are the importers forced to buy at the worst moment, the producers whose wealth is trapped behind a risky corridor, the governments that must subsidize fuel, food, or electricity, the companies that cannot pass on higher costs, the crews that carry real danger while others describe risk in financial language. The
the households that never look at a map of the strait, but still feel its pressure in energy, transport, fertilizer, or food prices. That is the structure Hormuz reveals. It rewards optionality. It punishes dependence. In calm times, Hormuz looks like infrastructure. In crisis, it reveals hierarchy. It shows which countries can protect themselves and which must accept the market. It shows which companies can reposition and which are trapped inside fragile supply chains. It shows which governments can absorb a shock and which must push the cost into public budgets. It shows which forms of power are visible and which are hidden inside insurance clauses, storage tanks, naval patrols, credit lines, and shipping routes. The most important lesson is not that oil is valuable. Everyone already knows that. The lesson is that access is valuable. A resource has limited power if it cannot reach the market. A buyer has limited security if it cannot replace the route. A ship has limited usefulness if the corridor becomes too dangerous. A contract has limited certainty if the geography behind it becomes unstable. Hormuz proves that in global energy, the path can become almost as powerful as the product. That is why a few miles of water can move billions. Not because the strait creates oil, it does not. Not because every crisis produces the same winner, it does not. Not because every ship stops when danger rises, they do not. Hormuz moves billions because it controls the margin between confidence and fear. When confidence is high, the strait disappears into the background. Cargoes move, prices settle, insurers calculate quietly, governments issue statements, consumers rarely think about the route. But when fear enters the passage, the background becomes the center of the global economy. Every barrel becomes a question. Every ship becomes a calculation. Every importer asks what certainty will cost, and someone is paid to answer. That is why the Strait of Hormuz is not simply a place where oil passes. It is a place where risk is converted into money, and money is converted into power. If this documentary helped you see the money behind the crisis more clearly, subscribe to Capital and Consequence. Share it with someone who follows energy, geopolitics, or global markets, and leave a comment with the next financial power struggle you think we should investigate. Because the real story is rarely only the headline. It is who profits, who pays, and what changes when the world is forced to follow the money. The strait may open, ships may return, prices may fall, but once a choke point reminds the world how dependent it is, the consequence does not disappear with the tide.
For viewers who want the complete research dossier behind this documentary, the Capital and Consequence dossier is available in the description. See you in the next video.
Capital and Consequence. Follow the money. Understand the consequences.